Hi, Warriors. Who has a plan? What is your plan? Hello, Mike, Bran, Glenn. Hello. Hi, Kman, Sinatra, James. I was thinking of throwing my hat into the ring, Ingmar, and my platform would be more FX volatility. All right. Make it legal to have a bear market in stocks. No bailouts, no bail-ins, end the Fed, and a debt jubilee. Do
How
I have
about
your vote?
how about free tickets to Disneyland for your mates in
Uh,
England?
yes, definitely. Anyone that I know that's my friend can travel for free all over the world.
Done. Voted.
Okay, so I hope that you guys are on the horn talking about the Pinkert candidacy. Anyway, let's talk about making money. So, because I'm going to need campaign funds, I have to get my own private plane. Right now, I'll just be traveling in my car. But anyway, here we go. All right, so why don't we start off with Kman? Good morning,
Good
Kman.
morning, Dale. Good morning, everybody.
So, so far we've had, this trend line break in yen, and it looks like it wants to hold here, that maybe we get some type of A, B, C up here, or maybe more than that. Your view on the end coming into this week? I think they have inflation numbers.
We had some inflation numbers last week.
Oh, okay.
What do we have? The Tokyo perhaps at the end of the week? I don't know. Yeah, the Tokyo CPI, but we had the national CPI before, and we will have Tokyo CPI data on Friday. As I was saying on the flow show, we are in mode where people are taking regularly yen shorts off. But if you look at, especially on the crosses, and I've been showing a few of them as well, on the medium term, exactly from those lows in December to the highs, we're still seeing only relatively subdued retracement, which in amplitude, they may seem big in number of pips because we did do a big move from 140 up to above 116, the dollar yen, obviously. And the crosses did similar, but we are already holding around those first Fibonacci retracements. I think we are in a mode where we are going to take the volatility into account, but going to trade up and down for until the Bank of Japan next week, end of next week. We are in this 1.5 week, big 1.5 week to go. And I reckon we are in a kind of a consolidation mode. There's going probably to be a few messages sent out here and there, and then we will see. Obviously, there can be moves in the other side of the yen pairs because we have the US GDP out. We have a bit of risk to take into account. But I think we are more in a bit of a yo-yo than anything else right now. So I don't. Well, I mean, I would be surprised if we can really get back materially above 158, the broken trend line. But I'd say on the white, 155, 158 for the next sessions.
Yeah, 58's big. You have the 9-day, you have the 50-day, you have the trend break, everything at 58. So
yeah, and we can
that's going to
travel
be a big
300
number.
points, right? We up and down. We have done more than 100 this morning already. So done 150 nearly this morning. So we have to take into account how high the vol is in yen, people getting in and out all the time, and yeah, so I'm looking at more like a range market now than really picking a fresh direction.
Okay. Euro wise, it looks like we're having putting in a little bit of a head and shoulders top. just like the Dixie could be putting in a little bit of a head and shoulders bottom. We could still be developing the right shoulder. And it sets up, if you just take the Euro formation, down to about 820 to 108, which is the level I'm looking to buy. So this formation is setting up maybe this break here. And the Dixie, if it sets up the same thing, just call it 440, 360, could give you 105, 105.20. I'm not going to trade a counter trend because I do believe that we're in the beginning of a downtrend. It makes me a little nervous with, all the press about uh, former President Trump and Vance wanting a weak dollar, and that people may begin to start front running that way ahead of, if they win, and then it takes time. They don't take office till January, so just trade the charts.
Yeah, because I think some already did it, and we had this Trump version 2.0 trades coming in, and it got unwound quite hard as well. So we got to be a bit careful by front running too early.
And this was a pretty feeble rally in the 10-year. I still think it's looks weak to me, and TLT still looks like it wants to go to the upside. These pauses are, shallow. So we'll see. Silver and gold still under pressure.
Yeah,
We'll
silver is not behaving too well. I mean, with all the commodities coming down, and I've actually took all my preset bits out, and I'm really going to watch it and act if I need to. But I don't particularly like this price action too much.
Yeah, gold's not much better after a 3 drive to a top formation.
Yeah,
It's better, but vulnerable.
yeah. There's a few bits, a few supports around here. Prior high.
Yeah.
Let's see. I mean, the next 15 bucks or so, it should hold, or we could go all the way back down to well, for 23.5 for a starter. That's a possibility.
Yeah. Or take out 2280.
Yeah, well, that remains.
Not a prayer for that, huh? Okay.
Well, I mean, I'm not looking at it that way, but well, I mean, don't never say never in
Yeah.
anything. But I found the fact it held that well down there. That's going to ask for a new event, I think, to take that one out.
Okay. So risk had a pretty negative week last week, a weekly key reversal. The S&P has been stronger than NASDAQ, and we're getting a bounce today. Now, I'm not saying that this is, and there's no way I could know that this is a major top, but I do believe it has enough durability to hold for a couple of weeks, not just for a day or two. So, I'd be selling rips. The weakness is NASDAQ 100 and tech stocks, but I'd sell a rip in the S&Ps between like 5.5 and 56. And NASDAQ, I think we'll have at least one more of these from wherever the rally ends. That we could have at least 3 weeks, maybe into mid-August, some type of correction. Same thing with NASDAQ, sell it up here between, 20,000, 22 if it hasn't much strength. But these were pretty bad. This was a 2-week reversal in NASDAQ as well.
Big trend line at 5,500 or around there in the S&P, right? And we held right on the trend line support.
You mean this?
5,500, yeah.
That's a 9-day moving average, but I guess there is a trend line there that I
Yeah,
do not complete. Yeah. Okay. So the S&P's held it and NASDAQ broke it if you had the same type of trend line. So that's the way risk looks to me. And I just wanted to ask you guys about WTI because I think it may have pulled back a little bit too deep to keep the technical case going for higher oil prices. What do you think?
Yeah, I don't.
Monsieur Trump.
Huh?
Mr.
That's
Trump.
a Trump play too. Drill, baby, drill.
Drill, baby, drill.
Okay. All right. Well, let me get you in here, Ryan. What's your plan for the week? I know you think about it on the weekends, even when you're on vacation. I know you're an addict.
Yeah, Bank of Canada Wednesday is going to be a pretty big one. Not so much that they're expected to cut rates, but what they signal going forward. They when they did their first cut, they messaged that there will be a limit to the divergence between them and the Fed. Obviously not there yet after one cut, but this second cut will open up this divergence, and so maybe we'll get an idea how big or where their limit is. They've made a bit of a rod for their own back, making that comment, because now the market's going to go, well, how much is your limit in monetary terms or number terms? That could indicate whether we're going to get any more from the BOC or whether they're going to go on pause until the Fed start moving. And that might even give us a bit of an inclination on what the Fed's doing, because we know they all speak to each other. So if they keep going, that might mean they know that the Fed is going to be up to something in the next couple of months.
Okay. I mean, to me, it looks like they're going to at least go for some type of stop hunt. They already have these guys, or about
Yeah,
to.
we've been ranging there, haven't we? You know, we tried that 136 and look how solid that was, and now we're going the other way.
Yeah, I was
So
wrong
yeah,
about that. Yeah,
I'll be
so
looking
far.
up towards those high 137s into 138 for a possible short, just to play the range. And then
Okay.
Thursday we got the first US GDP numbers for Q2, so that's going to be another interesting watch to see how the US economy fared in the second quarter. You know, we've got that surprise 1.4 in Q1. It's expected to bounce to 1.9. How are you feeling about it, Dale? You seeing growth going gangbusters?
No, I don't think so. And I think that last week, I think you have to sell rips. I think that we're gonna, have a maybe similar type of correction that we had in April.
Yeah.
Maybe something like this, and then it's going to launch again, maybe. But you never know. We talked about before we started getting these kind of signals to be looking for key reversals.
Yeah.
That's how we know, at least that we have a reference point to be wrong against. And NASDAQ never threatened its key. So, I mean, if you even sold the close on the key, you're doing okay.
Yeah.
So, look here. I mean, we're right here at this 50-day S&P, well above the 50-day. Okay, but NASDAQ at the 50-day, if it cracks it, why can't we see the 200-day? Or at least, do some kind of equality, like, A, B, C, and then a B, and then a C, something like that, possible. The other interesting formation was what the Dow did Friday. So we had that throw over, right? Pretty big one. And we're on the verge of negating it here, which is kind of similar to what Amazon did with the false breakout that it had. Where are you, Amazon? Here you are, over 191. So I was looking to short it on a third drive, but it was just too powerful. But, doesn't look too good here. I think you could get short, up around 190 and risk the highs on Amazon. You're wrong if it closes back over the pivot.
I think the GDP is going to be important for stocks. If it's soft again, is the market going to take stocks higher, like it usually does with bad data, or is the market going to sniff yet again that there's some weakness in the economy and that's no reason to be buying stocks?
I think there's a lot of earnings coming up too. So,
Yeah.
we've had a lot of beats for a long time in earnings that maybe, some economic weakness starts showing up or margin pressure because of the cost of things in the earnings coming up this quarter. I think they start again. Well, we had some last week, the banks. So, I know people are going to try and buy the Russell, right? Because, that's a great rotation we have going on. And we're almost back to, maybe back here they'll try it. 215, 210. If this aborts, then there's big problems. If this was just, some type of aberration and not a breakout, I'd say it would abort closing back under 210. So, draw a straight line in the Russell at 210. That's where you buy it, and that's where I think it has to hold. So we'll see. Probably coming in higher today, 218. It's coming in, so that's about 14 higher. We'll see. But the metals now they're even getting to the gold. So I think there's big buying opportunities coming here. I don't know if it's going to stop here or trade here, but I think so. That there could be some nice buying opportunities coming in the fall for gold and silver. And we're not that far from fall, right? A couple months away. So,
oh, please bring on the fall.
I know, Blake. I know. Remember the movies where how they would show time passing by pages of the calendar blowing away?
Yes.
Yeah. So I've been imagining that we're in late September, early October. So, what do you think after this weekend? Thinking about things, Blake.
Well, first of all, good morning. Good morning, Dale. Good morning, Kman, Ryan, and everybody listening in. After this weekend, I think the market having a little bit of surety that Biden's dropping out, and I think that was like kind of like the market was wondering what was going to happen, and I think that confirmation is going to keep risk appetite a little bit bid for now. But there's not a whole lot happening today as far as data goes. So I'm using today's action to actually take some profits off the table. I've been short Aussies since the 5th of July. I actually just pulled my full position off in the Aussie just now, actually about a half an hour ago. And because that's a little bit of a false breakout. But like I said, I'm going to use these moves today as opportunities to kind of take a little bit off the table at this point.
See that.
Yeah, I mean, the Aussie's been a perfect like false breakout.
It did like what Amazon did at 191. Tried to turn good, and yeah.
But you look at copper and how weak copper is, and it just fed into Aussie dollar weakness, and yeah, it's been great, and also with precious metals coming down as well. So
yeah,
like I said, I want to take this as an opportunity just to close some things out. I think there's a lot of data that could move the markets this week. As Ryan was pointing out, the advanced GDP number I think is going to be a potential market mover. As you said earlier, we have a lot of earnings that are coming out this week, and then we have PCE at the end of the week, which after having CPI and producer prices come in, I don't think it's going to be a big surprise what we get with PCE, but still it could be a market mover at the end of the week. People are still paying attention to what's happening in inflation. So but I think what's most interesting is you were talking about these precious metals. They have really, really come under pressure. And I think that's truly leading the market at this moment. With not only the move in gold, silver looks so vulnerable right now. So
here's platinum. they all do. They all look kind of ugly.
Yeah.
Yeah. So, but I think they're going to be great buying opportunities setting up. I forgot what I was going to ask you when you were just talking about this. Anyway, what do you think about the yen here, Blake?
I'm with Kman. Kman, I think I heard you say a little bit earlier about kind of trading the range. I mean, first of all, I think we broke the channel. Actually, you don't want me to take over the charts,
Yeah, go
Dale?
ahead.
Yeah, I'll take over the charts, but we should probably have a little bit more of a conversation about the yen in particular. I do think we're below channel support. And I still have yen exposure. I'm still short Kiwi yen. I'm short some dollar yen and euro yen, but I'm using this. I kind of agree with what Kman's saying that we're more range bound, but I would still sell rallies in the dollar yen. I'm hoping we might see a rally back towards 158, and I'd add a little bit more dollar yen exposure up there. But let's talk a little bit about the BOJ at the end of the month. I mean, what do you think, Kman? Do you think the BOJ is gonna make any move with rates?
Could be two things to watch, and I think both are plausible for the end of for the next meeting. It is the reduction of the bond buying and a potential rate hike, and now it remains to be seen how much of each they will do. If they really go with what the mega banks are asking and reduce the monthly JGB buying to 3 trillion yen, that would be a big cut. If they add on top anything that goes above 10 BPs move, 10, 15 BPs move on the rates, that would be big moves. Now, if they decide to go on a slower path, that is like somewhere between 1 to 2 trillion JGB reduction, which would still bring it well below all the redemptions for the fiscal year. So they are going to take de facto some money out. But if they only would like raise the rates by 10 or 15 max BPs, we may be in some kind of similar situation compared to what we have seen after other BOJ meetings, albeit that I do think that we are not going to see those outsized moves anymore. We could continue for the yen to weaken a bit, but that will depend on also what's happening outside of Japan. But I would say that the speed of everything will really, really slow down because the other central banks are looking at the other side. So rate differentials will come back in time. And so everything will go slower. And in the meantime, yeah, I think $158 yen is probably a reasonable top side right now, 155, 5.5 bottom end. And that's where we are. And then you look at all the yen crosses, how they behave. Yeah, you're on the euro yen there. I think this is quite telling that the party is not over yet. Because we are stalling on the 23.6 and you have a support trend line there. Yeah, and also on the dollar yen, we tested once the bottom side and once actually earlier today the top side of the daily cloud, and which is 150. Well, it's right around where those two lows were Friday and today, and that also will be important for the Japanese community, of course.
Yeah, now let me ask you this: as far as dollar yen goes, do you think it's possible that we revisit the 152 level? I mean, because ultimately that's like the critical level for anybody who wants to be bullish or is a yen bear. Do you think we can make it back down there again?
Yes, over the course of the second half of the year, yes, I absolutely think we can get down there, especially if you reduce the interest rate differentials and if you look at like Nikkei starts to look a little ish. I think we can get down there, but will the yen have the power to strengthen beyond what those reduced differentials are going to tell us, that is still remains to be seen. And for the time being, my, what is it, 1st, 2nd of January prediction that we end the year above the open is still valid.
Yeah. All right. All right. Hey, so Ryan, let's talk a little bit about and thank you, Kman. Let's talk a little bit about Eurozone, UK, and US PMIs coming out later this week. Because, you know, I mean, I'd really hoped that the euro was going to make it to 110 last week. I really wanted to sell it up there. You know, we kind of failed up there, and you can see the euro's just trading really on what I would consider as pretty key channel support at the moment. Matter of fact, if you want to be buying euros, this is the place to do it, because you know where your risk is. It's very manageable from here. But, you know, are we still going to see the U.S. exceptionalism, or do you think that U.S. economy is starting to slow to a point where it's going to impact? We're going to see, you know, slower U.S. growth. What are your thoughts as we go into this week?
Well, if we believe the data, like the PMIs, like the housing data over the last 3 months, you know, retail sales, other things, then this quarter shouldn't really be much better than Q1. So the fact we're expecting a jump to 1.9%, you know, you might think the balance of risk says it might come in back towards Q1's 1.4%, or maybe even lower. But you just never know with these GDP numbers; they can come out of anything. But as I say, we watch the data week by week, month by month. We've seen a bit of weakness in the job market. You know, across all the sectors, we've seen a bit of weakness. So, as I say, I think the risk is that perhaps we see a lower number than expected, maybe something more down to what we got in Q1.
How about like you know, PMIs in the Eurozone and UK? I mean, do you think growth is stabilizing, you know, in your neck of the woods and in the Eurozone as well?
Yeah, we're doing the same thing we've been doing for the last 18 months, just bumping along the floor. You know, everyone's over here's had the soft landings when we're just trundling along the ground, whereas the US is its airplane is still in the air. You know, we had some great growth numbers latter part of 2023 coming into 2024, and then it started coming down as well. So, yeah, there's always that divergence. And, you know, the euro is holding up. You know, 108.70 is the top of the zone I've got that goes down to 30, which is a real long-term zone, been going on for years. So I'm not surprised to see it bouncing from there, but it's going to need something else now to get it back up to those highs and get it through those highs.
Yeah, I don't even know what that is going to be. I would prefer to actually buy the euro on a dip if we can see a dip towards 107. This is obviously the big triangle that I believe is still in play. I sure as hell don't want to buy the euro right at this moment in time, especially knowing that the euro failed above 109.20 last week. So I'm going to be in the sell euro camp until we get back down towards 107. At least that's what my plan is at this stage in the game. You know, going back to you know, what we were talking about a little earlier, and I just want to go to the Aussie really quick because this has been extremely weak. I actually just took my Aussie shorts off from you know, right, you know, where I was, you know, short up here. I just pulled them off and updated the trades room. But notice this this old daily trend line. This is the big breakout in the Aussie that is so significant. I believe that we should find some support around the 66, you know, 40 or 50 level, kind of where we're at right now. But it still looks vulnerable along with precious metals, and you go look at copper. Copper looks like, whew, you know, do you have any? Let me ask you, Kman, do you think that we should be looking at copper the same way that we've always viewed copper from a global growth perspective? I mean, look at how weak it is.
Especially if you talk about China after the plenum, and I think that weakness in copper here, and that will probably have spilled over into the Aussie as well, and perhaps even in the metals and especially in silver. I think is A lot has to do with China, who can't really get their demand up and running, and yeah, so it is one to watch in the context of global growth, yeah, and demand.
Yeah.
They're exporting deflation.
What, China? You think?
Yeah, yeah,
Hmm.
that's what they're exporting.
Well, you know what? I think you have the perfect person on today to ask about China. I think I think it is about time where you're going to bring on Mr. Luke Groman, and
He's
I
not
think.
here yet. Like,
Oh,
I'm
he is
looking for him.
not.
Yeah.
Okay. All right. Yeah, but I think China is going to be exporting out a lot of things, and not just goods. So, but yeah, copper does look it is extremely weak. So let me ask you this, and while Dale's looking for Luke, I want to ask Ryan about the bond market. So what happens? And I want to ask you this question really quick. What happens to the bond market and like globally if we see some risk aversion? If stocks start to come down, do you think gold will, or excuse me, the bond market's going to catch a bid and we're going to see yields come down a little bit?
It depends where the risk problem comes from. Is it if it comes from the US? That's different if something comes from the Middle East or Russia or wherever it comes from. So it's not. I don't think in this day and age you can't just say risk off, risk on is the same thing when there's tons of different events going on at different places. What I think is certain at the moment is that more and more assets are coming under the influence of the US election. As I said, just looking at oil, that's coming off in part because Trump said he's going to pump baby pump, drill baby drill. So he wants to get oil markets down so it improves prices for consumers. But then you say, well, what's OPEC plus? And them not going to say if WTI drops $30 and drags Brent with it and all the rest, that's going to be a problem for them. So then then the risk trade switches from the US to the Middle East and the like. So it's not, you can't draw straight lines in these things anymore. But if you're talking general risk, then yeah, you're going to see bonds go bid again. And, then you face the consequences of that, what it does for the dollar and yen and gold and everything else.
Right. It's going to be a wild fall, and as far as I'm concerned, it's going to be a crazy one. I'm going to go ahead and Dale, did Luke get here?
Luke is here.
All right. Well, like I said, the perfect person to be asking about what's happening in China. And I'm going to pass it over to you, Luke. Welcome to the F.A.C.E show, and Dale, thank you so much. And thank you, Ryan and Kman, for getting us up to speed today. Have a great interview.
Thank you, guys. Welcome back, Luke. How are you, my friend?
I am great, Dale. Thanks for having me back on.
All right. Well, like Blake said, perfect guy to ask about what's happening in China with their recent, seems like the market's disappointed with what they came up with the preliminary, or what is it?
Yeah, the whatever the 5-year plenum plan or whatever.
Yeah. So copper's selling off, and it's almost like they're exporting a little bit of their deflation everywhere. What's your outlook there?
I think they're going to keep kind of going steady as she goes. I think they don't think they have as big a problem and as acute a problem as the United States has. And I think they're treating the United States government like toddlers, which is they're going to let them cry it out until they either, grow up or go to sleep. And what I mean by that is that if China accelerates growth, the U.S. is very clearly saying what it's going to do to China, right? Which is, as soon as we're done with Russia, we're gonna put you out too. So China can do one of two things. China can help the U.S. by stimulating, which helps China too, to be clear. or China can continue to slow roll this, manage their issues, run massive, massive trade surpluses, right? So dollar inflows. So they're at no risk of a balance of payments crisis. And then they're continuing to accelerate yuan denominated energy and commodities, which further makes it all but mathematically impossible for them to have a Chinese currency crisis a la Southeast Asia in 97. So if I'm China,
yeah,
as long as political stability is good, or at least workable, which it is, and at least as growth is okay, which it is, then doing anything to accelerate growth only helps the US, who wants to kill me. So why wouldn't I slow roll this and force Powell and Yellen to blink and into new QE, into stopping QT, into whatever it is they're going to have to do pretty soon to inject more dollar liquidity into markets, and basically throw it back on the lap of the Fed. And so I think that's what China's doing. That's what I would do if I was in their shoes.
Okay, so they're just going to stay pat with what they have. What's their advantage to us blinking first and stimulating?
Oh, that'll weaken the dollar. That buys them time,
Okay.
right? That weakens the dollar.
Okay. So I want, that's a great segue, because let's talk about the dollar with the candidates that are most likely to win. That the polls are saying, regardless who's at the top of the Democratic ticket. They want a weak dollar. How do they really? How does an executive branch accomplish having a weak dollar? Besides jawboning? What can the Treasury do? Could we have an overnight devaluation of the dollar like we've had in other currencies, which is what scares me, not if we just trade lower, 20, 30% lower, but it happens overnight. But could they do that by decree? How do we get to where they want to go? Because it took a
you
Plaza
could do that by
Accord.
decree.
Okay, because they took a Plaza Accord last time.
It took a Plaza Accord. I don't think the Plaza Accord's coming because the biggest parties you need there, right? We've already beaten. We're actively hurting the Europeans' ability to value. We're getting the Japanese to devalue, but that's that's in the wrong direction if you want to weaken the dollar. So, and the Chinese, I think we went to China last fall and said, "Hey, you need to strengthen the yuan." And I think the Chinese said, "If you want the yuan stronger, raise if you want the dollar weaker, raise the price of gold. Let the price of gold go."
Okay.
And that, I think, is one way you could do it. I mean, you could implement certain tariffs on certain border policies. There are things you can do there, but I think. Quite honestly, I think the easiest way for the executive branch to do it is provided for in the Financial Accounting Manual for Federal Reserve Banks, Section 2.10, which is President can tell Treasury Secretary to tell Fed Chair to raise the price of gold, to remonetize the gold is how it's phrased in this document. And the accounting treatment of this is that every dollar you raise the gold, the official gold price, deposits a dollar free and clear into the Treasury General Account, or TGA, with which the Treasury Secretary can do whatever they want. So the U.S. has 261 million ounces of gold. Every $4,000 to the gold price, the official gold price, is about $1 trillion into the TGA. So the more this goes on, the more I think we get some sort of October surprise or Nixonian shock where Trump says, "All right, we're done here. I'm sick of screwing around." Treasury Secretary, fill in the blank, instruct Powell to raise the price of gold by $20,000 an ounce. That puts $5 trillion
next year. That would be a year from October, not this October.
Not this October, no. But if it's going to happen, I think it's going to happen in the first half of 25. Because
that's possible.
that's the way, that gives you the max amount of time for the effects to occur, right? So if you do it, you've got a midterm election in November 26. The effects of devaluing the dollar against gold in such a way. Now, let me finish with the thought. You deposit, if you did 20,000 to pick a number, that's $5 trillion into TGA, $5 trillion that the Treasury Secretary then go out and buy back the Treasury market. Here, you take $5 trillion in cash, we'll take $5 trillion in Treasuries, retire them. US debt to GDP is no longer 122%, it's 70%. Based on the amount of treasuries around, based on the decline in the valuation of treasuries, based on what the Fed's done over the last couple of years. No, it's 70% debt to GDP. Great. That's now positioning the United States for growth. And oh, by the way, there's other ways you could do it too. Look, Judy Shelton has talked about this, who was within a couple of votes of becoming a member of the Fed under Trump. He nominated her, putting gold, a little gold sweetener into the long-term debt market. It's only a matter of time until basically foreigners like, we're done here. On our current course and track, like, we're not buying the long end. We'll buy all the bills you want. And, they have a word for, there are nations that finance to, massive deficits, 7%, 8%, 9% deficits, all in the bill market. And they're called generally banana republics. They're generally, it's Brazil, it's Argentina, it's, financing $2 and $3 trillion deficits in the bill market is highly inflationary.
Yeah, and once you get plenty of currency problems in both of those countries.
That's exactly it. And what did Trump just say last week? We have currency problems. We have big currency problems. It's a little different. It's on the trade side. The dollar is too strong for their liking and de facto for the national security of the United States. The dollar's strength is a threat to U.S. national security because it's forced us to offshore defense industrial base. So if you basically then you have debt to GDP at 70%, now the U.S. government can stimulate whatever it wants to do. It can start running debt back up again. So oh, by the way, when you revalue, the 20,000, that's probably extreme, but it doesn't necessarily need to be. When you do this, ultimately, you're going to increase inflation expectations in the U.S. You're going to increase inflation in the U.S. because all of a sudden there's going to be $5 trillion in new currency floating around, more government spending. There are other currencies that will go up with gold. And because their gold reserves will get marked up, so the dollar would fall against those. So that's one way you could do it. Another more subtle way you could do it is Judy Shelton's plan to basically like, hey, with every, any duration beyond 10 years, we are going to add, we're going to pay 2% plus, a few grams of gold valued at some really big number as a way of making our debt more sustainable. That's another way you could do it. You could do it by saying, look, American oil is now valued at whatever in dollars or whatever in gold, American oil exports. You could use American oil to do the same thing. So there's a lot of ways you could do it unilaterally, but it would have to be unilaterally. And I think gold has to play a role.
Okay. So plenty of ways to use gold or oil. Basically, a commodity would have to be used to make this happen, and they have options. I didn't know. I've asked people, and they said mainly jawboning. I didn't see how that could take the dollar down for a secular bear market. So, because I'm bearish the dollar, but it started making me nervous that people were going to start front running this trade, right? 6 months ahead of time. And I think the 105 level is going to be real key. If we start closing above it, strong dollar. If we take out 104, go ahead.
Yeah, I was going to say, and I think it's an important level to watch because tactically, right now we're in a setup that is very similar to last year at this time, which was we got that rally in the dollar from, call it 101 to 107 last year, if I recall. I can go back and see. Let's say. But you've got this quarterly refunding coming up at the end of the month. You've got the Fed coming up. You've got the the Congressional Budget Office just increased. Yeah, let's see. Yeah, there's that. So if you go to July 23, through, yeah, there it is. So yeah, like 98 to 107.
Yeah,
Right. Yeah. From
right here.
keep going right there.
Yeah,
Yeah.
yeah, something
That's
like this.
that's the setup we're in right now from a fiscal standpoint. If Yellen comes out and says, listen, yes, the CBO just raised the second half deficit by 27% to almost $2 trillion. And we're going to do it all at the long end, or we're going to do more at the long end, then you get a dollar breakout probably above that 105 back to the highs. And we're going to go right back to that playbook of last year at this time, which is the treasury market dysfunction, stocks sell off. Only thing that goes up for a bit is the dollar, then gold goes up. And then eventually they come in, they inject more dollar liquidity. We go through this whole rigmarole again. Now, might they do that if they think they have no hope of winning the election? Maybe, but I think that's being too cute. I think they want to try to win the election, and having the treasury market and the stock market sort of go down 20%, like the treasury market did in the third quarter of last year. At the long end, I don't think that's helpful to winning elections. So my guess is we will get favorable liquidity in whatever it is, 2 weeks, I guess we're at now, to those, both the Fed and Treasury. But let's see. That's tactically, that's how I think that range that you outlined could play out to the up and down side, right?
Okay. All right. How about 10-year here, Luke? I know you're not a bond fan, but I look at this 10-year, and we're trying to hold the 420 level, but taking out 420 is going to measure much lower for the 10-year, and the rallies have been weaker and weaker and weaker, and it looks like we could trade back towards 350 in the 10-year.
It depends what the dollar does, really, right? If the Fed comes out and says, we're going to stop QT in 2 weeks, which I think is a possibility, actually, because the plumbing is starting to require it. We're going to stop QT, and in September, we're going to do one cut. Then I think 10-year yield paradoxically goes down. I think it breaks below 420. And I think, and now if we ran that same chart of gold over, 10-year, or S&P over 10-year, or Bitcoin over 10-year, like I think the 10-year will wildly underperform gold, S&P, NASDAQ, Bitcoin. I think all those things will rip a lot more than the 10-year on that type of liquidity injection. But purely from a 10-year, I could see that happening. So for me, the bonds, bonds, the long end especially, are just a whole lot of work for not a lot of reward, right? In terms of trying to figure it out, which is to say, like if they don't inject more liquidity, yields are going up again, and if they do, yields probably will go down a bit. But the higher octane way to play that is sort of, gold, Bitcoin, stocks, NASDAQ.
Okay, well, I mean, Bitcoin came back like a lion last week, but with the sell-off we had in tech stocks, Mag 7, AI, the bonds actually held. So, they didn't rally like they used to in the old days, but they didn't sell off either when we're having risk off. Is it possible if we have more risk off, we could get a rally back towards par or 110? And then this would just be a bear market rally, and then
It's always possible. Yeah, it's always possible. But I think there's a real message when you have, the trillions and trillions of market cap that sort of, went away last week in tech, or last 2 weeks in tech.
Yeah.
And that's all we got in the long end. Like that's all.
Good point.
Yeah, you know what I mean?
That it could hold.
Yeah.
All it did was hold.
I think there's starting to be a recognition by the market of sort of this the nominal growth has to be above our, rates, or else the US and the West more broadly goes into a death spiral.
What are you looking for What are you looking for GDP this week?
Oh, jeez. I don't even really have a number, to be honest with you.
One and
I think
a
it will
half.
be better than expected. I think it'll be better than expected.
Okay.
Simply because, April and May, for example, nominal or U.S. government outlays were up 22%, 23% and 22% year on year. So if, with the government being 23% of GDP, just the government is driving a 5.1% nominal GDP growth for the entire economy, all by itself. If the other 77% of the private sector is flat. And the 77% that the private sector, I don't think it's flat. I think it's still growing a bit. There's certainly areas of weakness with commercial real estate and et cetera. And then we also have this other weird area where, look, the boomers have $116 trillion of the $166 trillion in wealth in this country, or people over age 55. So boomers and the oldest Gen Xers. And those people are spending like there's no tomorrow. And so there's this, conversion of asset price inflation that was never, it was sort of like never counted for anything. And now it's coming into the real economy at a very steady rate. So between government spending, which is really strong because rates are high, and because boomers are, the media spent 3 years telling them they're going to die sooner than they think, and now they're out spending like they're going to die sooner than they think. I don't think either of those things stop. Yeah, I don't think nothing stops those things. If the Fed cuts rates, then the government outlays will slow. If the wars stop in Ukraine and all this other stuff we're doing, then that'll slow. But of course, cutting rates, I think, reaccelerates the private side.
Okay, so you really don't see a recession on the horizon, do you? With everything you just mentioned.
No, I don't think we're going to get a recession at all. Basically, to get a recession implied is that we have a financial crisis. Treasury yields at the long end go up, and the treasury market starts to dysfunction, and then the Fed says, nah, we're not going to do anything about it. And oh, by the way, any deposits over 250,000 in a bank, they're going to go away too. So get your money out, then we could have a recession. But failing that, unless the Fed's willing to stand aside and let treasury auctions fail, which in my opinion has less than 0% chance of happening, I don't see a recession happening at all.
Okay, so what could bring about a bear market in equities? I know it's illegal for it to happen, right? But if it was legal, what would spur a bear market in equities? Could it be that earnings driven, they're compressed margins because of shipping costs and all the costs that go into that, squeezing margins now for companies? They are extremely highly valued. I mean, you look at
Absolutely.
You look at Nvidia. It hasn't made a new high for a while, and this was the superstar, right? Those are a couple of ugly weekly candles, the key reversals.
Yeah, that is. That's very ugly.
Kind of ugly, and I know that any kind of reversal signal you get in risk are short-lived. They last a day, but I think that this has at least weeks of durability for a correction, maybe into mid-August or something. Could it be earnings, which I don't know who is it, Kudlow or Kramer says it's a mother's milk for equities, our earnings, that we start getting some disappointment and people start to think that maybe the economy is slowing, even though you're not looking for a recession, that we have a growth scare?
I think that we can get a growth scare, but the challenge is that, with Kudlow and others, is like, when was the last time we had a growth scare with debt to GDP at 122% and deficits at 7% at full employment? And the answer is never.
Yeah.
And so to really get, I think, a real equity bear market, now I do think you get a vicious sector rotation out of the NVIDIAs of the world into industrials, et cetera, a la 2000, 2003 kind of time frame. I think that's certainly possible. But to get an honest to goodness equity bear market with debt to GDP and deficits to GDP this high at full employment, you need one of two things. You need that growth slowdown to cause treasury dysfunction, And Treasury dysfunction is like what we saw in the third quarter last year, where TLT crashes 20% in a quarter. And it causes problems with other banks, like whether it's Schwab or whether it's Signature Valley or Signature Bank, Silicon Valley. And then the Fed goes, hey guys, anything over 250, you're not getting your money. That's it. Then you're going to get the feedback where these banks are going to start selling more treasuries. You're going to get rates up, stocks down, and you're going to have money, people panicking out of banks, probably into T-bills. Then you could get a recession, I think, and you could get an honest to goodness bear market. That's one way. The other way you get it is capital. Given all this, is capital flow driven, right? And it speaks to, again, why I think a dollar devaluation probably has to happen on a snap, relatively overnight basis, whether it's literally over a weekend or over a month, which is, if you come out and tell the world, like, hey, we're taking the dollar down 30% over the next 2 years, like, then you can get a bear market. People go like, okay, well, ultimately that probably manifests again more as a bear market in NASDAQ and a bull market in industrials and commodities in the US. So a vicious sector rotation, given the relative market caps, that probably does result in a bear market at the headline indices for at least a bit. So it would have to be either the Fed says, hey, we're actually going to implement austerity on the federal government by saying we're not gonna cap volatility in the treasury market, like we've been doing for 5 years, by the way, right? The next repo spike goes 9-10, and the Fed goes, good luck, everybody. Enjoy your 11 to 12% mortgage rates. We'll get a bear market then. That ain't gonna happen, in my opinion.
Well, you said
but the capital flow side with the dollar.
Yeah, you said the Fed's last time we talked, the Fed's biggest nightmare is a bear market in the dollar, and yields.
That gets it really hard to control. Yeah, right. Because now your dollar down, rates up, stocks down. That's everything down, and that's sort of why I think part of the reason why this election is so contentious is the financial people, the Fed, etc., all look at this and go, "Oh God, that is our worst nightmare." And in the short run, they're 100% right. But of course, they always only look at the short run. The intelligence and defense people are saying, no, that's not your worst nightmare. Your worst nightmare is that this doesn't change. And our defense base, which is already critically dependent on China, becomes completely dependent on China. And now you have no control over anything. And, you may think you do, but you have now, by offshoring, you have become a subsidiary of China Inc. Have a good day. And those are the two, I think, tectonic forces at work in this election. And why it's so contentious is nobody wants to take that pain in the dollar in the short run and risk those capital flow issues when ultimately it's the right thing for the US, right? It's a vicious sector rotation. It's bad for Wall Street. It's bad for Washington, certain interests. It's really good for America to weaken the dollar. Keeping the dollar where it is really good for Wall Street. It's really good for certain Washington interests. It's really bad for America.
You had a few tweets about hillbillyology, Luke, and guys like Larry Summers read it, said he learned about economics by reading that book. He learned some things. So the message from Vance's life translated into policy is going to be a big change from what we've had for decades, isn't it? Can you explain if he has influence over Donald Trump in being the vice president? Usually they don't have that type of influence, but I would think that former President Trump picked him because he may agree with a lot of these policies.
Yeah, I think that's right. I think if you look at Vance has made it very much a point to point out the dollar as having a resource curse. His words, not mine. In other words, dollar Dutch disease, which is something I've talked about for a long time using phraseology from the FT, Financial Times. But it's basically, we are the Saudi Arabia of money. And when you have Dutch disease, you get some sort of resource curse where the rest of your economy shrivels relative to that resource abundance. And in the same way, having the reserve currency. It's great in the short run, and it's terrible. It drives sclerosis in the rest of your economy, other than Wall Street, banking, and your central government. And that's exactly what's happened. And so I think Vance pointing that out. There was an exchange he had with the Fed chair, Powell, about a year and a half ago, where he flat out said, "I'm not sure the dollar's reserve status is a good thing for America anymore," which is blasphemy, of course. But I think Vance is likely to continue to push that view. And I think, again, it comes down to the defense not even industry, the national security establishment in the United States has known this for over a decade. They've been talking about this for over a decade. And so I think Trump and Vance are merely the manifestation of that.
Okay, so whether or not we have one rally first, Luke, maybe you're thinking maybe something like this is happening from here. It could take us a 110 or so before.
I'd be surprised if it gets to 110, to be honest. I think it gets to, on that chart, maybe 105, 106, because
okay.
We've seen,
we've already been there.
Yeah, maybe 107. But remember, 107 last year basically blew up the Treasury market.
Right here.
107 on the DXY saw TLT down 20% in a quarter. And that kind of thing will happen again, I think, given if we get that kind of rally. So, I don't think I think the upside downside is still attractive here. I fully readily concede you could get that sort of bounce in the dollar from here tactically, just because we don't know what Yellen and the Fed are going to do. We can see that the dollar liquidity issues are rising again. We can see all of that. We just don't know how they're going to respond in the very short run. In anything beyond the very short run, we know exactly what they're going to do, which is weaken the dollar to keep the Treasury market functioning. And that's if Trump loses. If Trump wins, I think it's a very, away from the very tactical around this QRA at the end of the month and this Fed meeting at the end of the month, you've got I think, 107 upside risk to the DXY and, 90, 95 on the downside.
Yeah, that's what I'm looking for. So I'm, last time we talked, we were up here, I was bearish.
Yeah.
And I'm going to try it here, regardless of what the political dialogues are, because if we fail from these broken trend lines, I can come up with your target. You're talking 95, right?
Exactly.
So,
yeah.
All right. So 107 or 106 to 100. Take out 100, there's your 95. If you really want to get bearish a dollar, you take it from here at 114.5. So that's 1,400 handles from par. That gives you 86. So
and that would just get you back to like 2014 levels, right? I mean, 20. Yeah. But that's not crazy.
And let's wrap it with this. Two things on China. China came out a couple months in a row and said they didn't buy gold 2 months in a row. I say that they put that out there so they could buy the break. What do you think?
I think it's very possible.
All right.
Yeah, I think it's very possible. I don't put
I
much...
mean, they're not doing it to try and give people a heads up. Yeah. Right? Okay.
No, I mean,
Go ahead.
Yeah, no, who knows? I mean, I agree with you. We know, if you look at a chart of gold over, the long bond, over like ZB1, if you look at that chart, it tells the story, right? Gold divided by ZB1 is so powerful. And Charles Gabb, Louis Gabb's father, said back in 2018, like, gold versus the long bond is the line I'm watching. And if China's winning, gold's going to go up versus the long bond. And if China's losing, the long bond's going to go up versus gold. And it is so crystal clear. Not only is gold winning massively versus the long bond, but it's starting to hockey stick. And so, in the short run, is China taking a pause to, let the chart come to them? Are they letting other trading partners buy some up? I mean, I think one of the biggest stories that nobody's talking about is that Swiss exports of gold to the Middle East, the Gulf Coast countries, has gone from, basically nil 3 years ago to 110 metric tons a year, like a year and a half ago, to it's running 300 to 350 metric tons a year over the last 6 months. So all of a sudden, the GCC nations are taking down 7, 8, 9% of global mine supply annually. So we know what they're selling. We know what they're selling to create the trade surpluses to buy that gold. And we know the message of buying gold because their treasury holdings, generally speaking, have been trending down. So they're selling treasuries, they're buying gold with oil, and the oil market is a cool 12 to 15 times the size of the physical gold market globally. So like, it doesn't take much oil bidding for gold for the gold to oil ratio to just keep rising. So I don't really, to me, the BRICS currency is gold. That's that people have been looking for what that is. That's what it is. It's gold. It's gold. And to the extent you're going to net settle trade in gold amongst the BRICS, gold doesn't have the right digit in front of it.
Okay. And I know a lot of gold people are looking for a signal when comparing gold to stock market indexes, where gold begins to outperform. Not that they both go up together and go down together, but the fact that money flow will show that compared to stocks, which might be starting to happen here. I think we're getting close to where gold becomes really the magnet for money compared to the stock market. The stock market has been. So that's another big ratio that people are watching. And we're almost
that makes sense, right? That's how I think you get your bear market. People saying, hey, are we going to get bear market in stocks in dollar terms? It's going to be real hard. It'll have to be capital flow driven, basically. But can we get a bear market in stocks in gold terms? I think that is highly likely. That I completely agree with.
Luke Roman, I always learn from you. Thank you so much for coming here and sharing your convictions with us on the market. And I recommend everyone goes to your website, From the Forest to the Trees, and get your research. Your goal is to have people relax through all the anxiety that's happening every day in the markets, and by having them in assets that you have conviction of and don't have to really worry about things day to day. You don't want people to have to live that kind of life, so you're guiding them through the confusion, and it's even confusing for professionals like us. So
Absolutely.
yeah, great job, Luke. And people check Luke's work out, and maybe you could be a little bit more relaxed about your financial affairs as well. Luke Roman, thank you for being here today, buddy.
Thanks for having me on. Absolutely. We'll talk with you soon, my friend.
All right.
All right.
Luke
Take care.
Roman, everyone. Find him on X under his name at Luke Roman. Have a great day. Join the team in about 7 minutes on the Morning Edge. We went a little over. Hope you enjoyed Luke. I always learn from Luke every time I have a conversation with him. Okay, Marcus, you're very welcome. And he also has a YouTube channel that you could catch. And that's a wrap. See everyone for Turnaround Tuesday. I'm figuring Turnaround Tuesday could be the time to fade S&Ps. So, but my preferred short's an NASDAQ, which is twice as strong as S&Ps today. All right, everyone, take it easy. Blessings to you, Sinatra. Adios.